Hey, everybody. Welcome back to the Blockware Intelligence Podcast. Hope you're all doing well. Before we get into the show, let me tell you a little bit about our sponsor, FTX US. FTX US, one of the largest crypto companies in the United States, is the safest, most regulated way to buy and sell Bitcoin, Ethereum, and other digital assets. You might have heard of FTX from their partnerships with Tom Brady, Steph Curry, or the recent Super Bowl commercial with Larry David. With FTX, you can trade crypto with up to 85% lower fees than top competitors. There are no fixed minimum fees, no ACH transaction fees, and no withdrawal fees. You can also use the FTX app to buy your favorite NFTs with no gas fees, supporting both Ethereum and Solana blockchains. Download the FTX app today in minutes by going to ftx.blockwareintelligence.com to earn free crypto on every trade over $10. Again, that's ftx.blockwareintelligence.com to get started today. Hey, everybody. Welcome back to the Blockware Intelligence Podcast. Today, we have two returning guests by special kind of request from all listeners, PlanB and Willy Woo. Last time we recorded, God, it must have been 3 or 4 months ago now. Episode did really well, got a lot of positive response from the community. So happy to have you guys back on. Willy's got some wine. I've got some coffee. PlanB, I don't know if you've got any beverages going on your way, but we're ready to rock and roll. How are you guys doing?
Yes, Superman, and thanks for arranging it again. I'm looking forward to talking to you. Much has happened since.
Yeah, likewise. I'm kind of bummed that I didn't meet you and the rest in the Miami conference. Still stuck in Hong Kong, but about to change soon, and hoping to, get back on the road and the scene and to feel the atmosphere again within the industry. So yeah, and this is actually my first podcast in, I don't know, 2 months. I've taken a big hiatus from all this sort of public stuff, but yeah, back onto it.
For sure. Yeah, I'm looking forward to maybe seeing you guys next year. We'll see. I think you'll both enjoy Miami a lot, especially given some of the COVID restrictions and stuff where you guys are. So looking forward to maybe seeing you next year. I guess to start, has anything changed since kind of last time we talked? Willy, I guess, how's the baby and PlanB on your end? I know you launched the fund recently. How's that going? Just kind of get us up to speed on, what's going on with you guys.
Yeah, baby's super cute. She's 10 months old now. Oh my gosh, the babies are the funnest thing ever. So, but they're all blockers, as any dad will know, they were super blockers on the time. I have a home office here, so it's funny, like little knock on the door, she wants daddy. And it's irresistible. They're super cute. But anyway, a lot's changed. Yeah, I mean, I don't know where to start. Yeah, everything's changed.
So, okay, let me ask you this before I ask PlanB. So, recently you had posted this thing on Twitter that you were going to kind of cease writing the newsletter. Did the baby play a part in that? I mean, what were some of the kind of reasons behind that decision? I think, that was one of the most, popular newsletters in the community. So, personally, I was a little surprised to see you had decided to kind of cease that. I don't know, just kind of walk us through what was kind of the decision making behind that choice.
I think I see a number of things. A number of things. One was that the on-chain analysis is less predictive than it used to be, and I think that's true in that, when the newsletter started, it was in a very high spot dominance zone, as most bull markets are spot buying through the hill, and now we're in this zone that it's institutions here, the ecosystem is much more complex, derivatives play much more of a part in it. It goes from one swing to the other, spot dominance to derivatives, but now it's much more complex. And so the accuracy of the letter was dropping, and there was a number of things regarding that. Bandwidth was one with the baby, but for the most part, it was always, in my mind, an experiment of 1 year. It ran on longer because people wanted it and all this. I could see that, but the reality was I'm not enjoying writing it anymore. It became like a homework assignment, and I think thinking through it, it's always been for retail and retail focused, yet I thought it was rock in a hard place because it's relatively, I mean, I simplify it down as much as possible to make it easy to understand. And it's great if you're learning about on-chain analysis, but for retail, I think a lot of people were not so much wanting to know the deep analysis, but to go, is it going up or down? And they were trading on it without really understanding the depth of what the market structure is talking about and understanding risks involved. And so I thought it kind of sets you up for this point. And I mean, particularly the first, I think the 5 months, like 5 months, I think there were 2 letters that were wrong and every other letter was correct. And so people were starting to just trade on it. And I knew that was getting dangerous. So, and then like as the market structure changed and like it became harder to predict, there was a lot of backlash. And I thought like, I'm probably not serving retail as I thought I was, because like you kind of set them up, and then if they're not, like if they're not taking a longer term approach, or if they're a trader with risk management, some people would be relatively new and thinking they could trade this, and they got stung, particularly in the May crash, and like people lost money because they were over leveraged, and I got a lot of heat for that, and I still think to this day, it's like, yeah, like there was a combination of things. And one thing was that like that thing, I did issue a letter, and it said we were down for months of bearishness, and that did eventuate, but people just go, I lost money, I was a subscriber. And I'm like, in the end, I was like, well, I'm not going to set myself up here doing this letter, which ends up being like this vehicle where people get hurt, and then there's all this toxicity back. So overall, it became very unsatisfying to do. And beyond that, I think, like the reason why I got into the space and on-chain became my thing was because it's all new, right? And I like discovering new things. And I think I knew that from the beginning, which was a 1 year letter. And now it's time to end it, to try new things. So there's a whole number of things coming together, and it just didn't make sense anymore. Outside of the money, right? It was a very nice, subscriber base. It was probably the most popular. I know we're probably in the top 5, even top 3 highest revenue earners on Substack at its height. And even now, it's still a ridiculous amount of money to kind of end. But I think it's just in terms of opportunity cost, I think I'd like to, do new things. Yeah.
No, that makes a lot of sense. PlanB, anything new with you in terms of just, in the Bitcoin world for you, or the fund as well?
Yeah, well, I guess I had a similar ride as Willy, that, the whole market, of course, went down. We didn't reach the 100K targets that I was talking about on Twitter, and the stock to flow model, of course, predicts. So, I have experienced that a couple of times now. It's the 3rd time actually, because it always goes in waves. And when the price is high, then you're hot, and you're the man, the myth, the legend. And when the price is low, then you're the planned bullshit, the scammer, and what have you. So kind of get used to it. But like most Bitcoiners, if the price is not very exciting, they go do other stuff. Those are actually the most productive periods. So for me, I traveled a lot actually to other countries that I could go to. As an unvaccinated person, I cannot go to the US or Canada, for example. So no Miami for me. But other countries, I won't say which ones, of course, but so I talked to a lot of people. I took some time off Twitter. You might have noticed that in those periods, the tweets are kind of general and not very specific and based on real-time analysis. But it was kind of a holiday, kind of meeting people face to face that I have met a lot through Zoom. yeah, a lot of business opportunities. So you guys must have had the same. Every conversation you have ideas, you have opportunities, and you can almost start a business every day. So you have to search that out, and there was of course time for some analysis and some thinking, which is also very good to do from time to time. So when prices go sky high, you're on podcasts every day if you don't watch your agenda, and right now it's a great time to do analysis, to think things over, and yeah, also business wise. So yeah, very very exciting. Although I'm right now I'm kind of ready for the next move up personally.
It's been nice to kind of finally get a breather and recoup a little bit, finally get some full nights of sleep and all that good stuff.
Yeah, exactly.
I do want to get into the stock to flow model, but we'll hold that off for a moment, because I kind of want to dive into this news today about Elon, just because it's current event, it's relevant, and kind of tie that into this like general push to decentralization, almost like free marketing we've seen for Bitcoin over the last like 6 to 12 months. So we've got this news about Elon today, offering to buy Twitter. A lot of that seems to be driven by his belief that Twitter isn't fully advocating for free speech. They're censoring people, all that kind of thing. In addition to this, we've seen, the whole Canada trucker situation, and whether you agree with that or not, and, kind of putting the politics aside, the fact of the matter is, you had people within the country that got their, essentially just savings accounts and bank accounts frozen without any kind of due process. And we've also got recently kind of the most, relevant of all these, in my opinion, has been the freezing essentially of Russia's reserves, and essentially, cutting out of Russia from the financial system. So, either of you guys, I mean, we could just riff on this, I feel like, for a long time, but, I think generally you've just seen this huge push and basically, free marketing on a global stage for why decentralization is so important, and basically really highlighting kind of the value proposition of Bitcoin as a store of value.
It's interesting. I haven't been on Twitter much lately, the last 2 months. So I just had to look it up and was like, okay, so he's offering to buy it at $54 per share. I noticed he turned down his board appointment, which would have restricted him to a cap in Twitter stock. Was it 14% or something? I forget. And he rejected that. So it looks like he's wanting to require it fully, well, obviously, but it's interesting because it's a very centralized approach, and I just find it interesting because this is kind of like a benevolent dictator model, which kind of works really well for a time until that person passes or they turn evil. But yeah, I think like it's a smart move because that's where the user base is, and that's what, we can talk about that, right? It's like you could build any number of decentralized Twitter and you won't get anywhere because you can't break the network effect that Twitter already has. Like anyone can build Facebook in terms of a product. Whether or not you can move that social network effect across into another thing, it's unbreakable. So it makes a lot of sense that you would buy out the existing, and from there, if you want to make it more protocol based, like I think some of the promise Twitter had in the early days was really much, it could have been a protocol of the internet, another layer of the internet, because apps were using it to message each other, and it was quite interesting until it got the board level exec decisions were, oh no, we will turn this into media and we will do advertising model, and it really shut down the full potentiality of what Twitter could have been. Like a whole apps ecosystem was connecting into it, and that got all shut down, and in a way it went against what the internet was about. And so I'd be interested to see what Musk does with it if he acquires it, whether or not it becomes much more back to its roots of really pure engineering, grassroots engineering, and kind of, like you let it go. Like it's like letting Bitcoin go to the masses, and letting it be free, and let the ecosystem decide compared to like a very centralized, altcoin project, which you see plenty of, where the founding team continue to, like, a lot of DeFi is really, it's just centralized finance with a blockchain layer, on it. So it'll be interesting to see what happens with it, but yeah, I like that. I feel like I trust the character of Elon Musk more than I trust the ownership of Twitter. If you look at it, it's Elon Musk, and then like BlackRock. Do you guys know Fidelity? There's a whole bunch of big money people, big money banking circles, and I feel like the world we live in is very much controlled by that kind of money, which have a very particular agenda that's been pushed. These are the same people that push the ESG agenda, that's back against Bitcoin. So I think there's a lot of hidden agendas that are that push through from the ownership of media companies, and so I feel like this is like nice. It's like something from outside of that fraternity taking over something that's relatively important.
Yeah, I agree, and these are very, very interesting times. And in my latest article, it's already 1 or 2 years old again, but I talk about these phases, right? Phase 5 is actually a phase we're in right now, and we didn't know at the time what the new phase would look like, and that it could be ugly. That was a chance, of course, but what we're seeing around us with war now in Ukraine, with Russia, with what we have had with COVID, with all the decentralization, things happening in China right now. We see it in Shanghai, Australia. There seems to be no country where things are normal, or like 2 or 3 years ago. Everything is changing, and whether you look from a geopolitical or financial investor point of view, it doesn't matter. Everything changes, and so I think we're kind of get a picture of what this quote unquote phase 5 is going to look like. But it will be the battle between centrally run companies and countries and the peer-to-peer or decentralized organized products and companies and maybe countries, because that's a trend that's very interesting. And especially if you travel, you see that a lot. People that are off the grid, that don't have bank accounts, that live from their bitcoins, and that send bitcoins to their family. And we have I don't know if you know him. It's a very famous Dutch family. It's the Bitcoin family. They sold their house in 2017, and they're living on Bitcoin ever since. It's Didi Taihutu. If you don't know him, look him up. He has been living on Bitcoin for 5 years, and he has the most amazing stories about also products and companies that make you be able to spend Bitcoins on travel, on cars, on all those stuff is out there. I don't even know 1% of it. So it's a whole communities are discovering what's possible, and countries as well. The El Salvador thing and the announcements that Samson Mo did, and all the countries that will follow. It's such an interesting time to be alive and to be in Bitcoin and to be at the forefront. So yeah.
And to that point, if anyone who's met Didi, you'll notice there's a glint in his eyes and a huge smile, right? And this guy is living a life. He's actually really alive, and there's immense joy in his freedom there. And so
he's a hero.
It's quite inspiring if you meet him.
Yes.
And it's I don't know. It's like I meet a lot of people on my travels also, and they're living like this, and there's a lot of energy involved because it's very free. It's very free and liberating.
Yeah, and they're starting schools everywhere they live. They're starting for the community, stuff for the community, a bit like hotels, Bitcoin resorts, Yeah, so they give a lot to the community as well. It's not only a nomad that's rich and goes from tax haven to tax haven. It's really, there's people, Didi not alone. There's a lot of people like him changing the world from yeah, these in a decentralized way.
Yeah, and I remember he gave away a lot of his wealth as well. That was the thing.
Yes.
And he donates consistently, donates to charities through Bitcoin. So it's a very inspiring way of living.
That's awesome, and I'm sure we'll see more of these people as that whole kind of like sovereign individual thesis kind of plays out, where people really aren't tied to any nation and they're just kind of, you know, borderless nomads, if you will, and you know they're not really tied to any central authority and all that kind of thing. So no, that's really cool. I think this is the guy with dreads, right?
Yeah.
Yeah. Okay. I know who you're talking about then. Very cool. So we talked a little bit about macro, just like slightly. I do want to dive into that more in depth. But before we move on, I want to discuss narratives. So, you know, everything that we just kind of talked about is about this kind of whole push to decentralization. You know, over the last, call it 2 years, the kind of main narrative that drove Bitcoin up at the end of 2020 was the inflation hedge narrative. I think one of the most like powerful things about Bitcoin is this like term I've dubbed like ideological malleability for Bitcoin, which it's just like a cool term I made up to say like Bitcoin is it can be many things and it's different things to many different people. You know, in an inflationary environment, obviously it's an inflation hedge. We'll talk in a bit why maybe Bitcoin hasn't been performing well over the last few months, ironically, because of inflation, you know, driving up yields, which is caused tech to go down, which is correlated to Bitcoin. We'll get all into all that. I think the other thing that kind of drove Bitcoin off the lows, in addition to just like, you know, tech correlation after January, was just this narrative of Bitcoin being like a decentralized bearer asset, right? You saw both Ukraine and Russia, you know, utilizing Bitcoin. And that really goes to show that it is apolitical. It's just money, right? It's just decentralized money. How do you think through in general, though, about narratives with Bitcoin? You know, it can also just be a growing payments network. As you've got your pinned tweet comparing Bitcoin's network growth to the likes of the internet and telephone, etc. How do you think through? Do you think price is just narrative and narrative will just attach to whatever price action is telling you? Kind of, how do you guys think through just the idea of narratives for BTC?
I think when I think of narratives, actually, I think of like the newspaper or any, like almost the Bloomberg report. Stocks fell today because so-and-so did this, or the market felt fair because of that. And it's absolutely bullshit, right? Like if you're in the market, you go, no, actually it hit the technical resistance and there was a bearish divergence and we rejected off that because all traders will have to sell because of that signal. That's why it rejected, and then someone found a narrative that also coincided to this day. And so when I look at the Bitcoin price, I'm like looking at fundamentally who's buying, who's selling, and then you can attach like, right. So like recently, the price has sold down very, very quickly off a week ago, and the narrative that's been attached to it has been, it's tax season sell-off. And wow, they left it last minute because the 18th of April is the deadline for many Americans, and there's assumed that that's tax sell-off. And you look on at the data, and it's like, well, overall there was very mild selling from hodlers. Overall, spot was buying, mass amount of coins moving off chain, on chain, off the exchanges. Actually, spot was buying. Who was selling? That was the futures markets, particularly the calendars market, which is linked to the CME and the sophisticated institutions who are trading the correlation to tech stocks and the S&P. So you got this narrative that it was a tech sell down, but actually it wasn't. It was traders trading this correlation. So that's what I think about narratives in terms of price action. Like I think they're too coincidental to some sort of reasoning, but not backed by any kind of the fundamental data you look at if you're looking at the markets properly. So yeah.
Do you think narratives
in terms of what? Yeah.
Oh, sorry. Go ahead. Finish your thought.
Well, in terms of what you just outlined, yeah, like yields increasing, tech stocks get pressure, then yeah, that is right. You know, it's those guys that are selling down Bitcoin, but you can see that in the data. And I think that's, you know, but like, I think it's very hard to attach narrative to without evidence. You know, just thinking, you know, it's correlation is not causation.
Do you think there's a reflexive aspect to narratives though? And PlanB, I know you want to answer, so sorry for hopping in before you spoke, but
no worries.
Do you guys think there's like a reflexivity to narratives as price drives up, right? The whole kind of the whole, you know, Soros theory, excuse me, of, you know, price drives up, their narrative follows, that drives price up further, which pushes the narrative even further and kind of has this, like, you know, positive feedback loop. Do you think we get that in Bitcoin, for example, like with the inflation hedge narrative at the end of 2020, or do you think it's just irrelevant?
I think PlanB has taught me. Actually, a lot of people have taught me who have come from mainstream finance world. That might have been true in 2017, but man, there's the beautiful carry trade to take the other side and yield. What is it like? I think it was up to 60% annualized, taking the other side and taking the heat out of the market. So I don't think it's so reflexive now. And you see that with a blunt top and a rollover, and none of this exponential spikes you'll see where people can't take the other side. So I not so much now, not for Bitcoin.
No, I was about to say the exact same thing. I mean, narratives is nice, but it's for newspapers, for marketing stuff, and there are some deeper trends, some deeper things going on here, and it's well, like Willy said, it's of course technological. It is the better money. So, like the internet, if you want it or not, it will be the thermodynamically better thing, and it will win in the end. The earth is round, not flat, and whether you spin a narrative around it that it's flat, it doesn't matter. Maybe it delays it a couple of years, but it will win. So, and also financially, it is an asset. It is an accepted asset, more so than a couple of years ago, and markets are maturing. And the cash and carry trade that we talked about a lot last year almost completely disappeared, which is normal, which is a sign of maturing markets, because a contango premium of 40, 50, even 60% is can't go forever. People, so in my worldview as an investor, as an ex-institutional investor, it's all about arbitrage. And in the beginning, of course, there was arbitrage in Bitcoin only, with exchanges in Korea and exchanges in Europe and the US, and then making catching the differences, which was an easy way to make money. And now the future, the cash and carry trade was of course a very easy way to make money, and everybody and his mother is doing it. So now that premium has gone down to like 5%, or what is it today, which is still better than in Europe. You're minus 1% on your bank account or something. So there's still, but that those parties are now in place. They have their funds. They're doing this trade, and this market is more efficient and bigger and stronger. So what's left is, for example, the volatility trade. That's one of the big things. You know, you can still make 25% a year with covered call writing and capturing the insane volatilities that have lowered, by the way. But yeah, it's obvious for Bitcoiners that the trend in the price, the fact that it's better technology and it will win and it will be adopted over time, is larger than the volatility that's caused by narrative X, Y, Z. But yeah, so that's one of the other things. And of course, the big play we're seeing right now, and it's very interesting, is the arbitrage with the fiat world, because Bitcoin can be seen as a foreign exchange thing. So not even a tech stock or a commodity, but a like a currency. It has a interest rate, and you can exchange it with other currencies. So you can make very hard arbitrages there with enormous sums of money. And it wouldn't surprise me. Actually, I know that that some traditional parties are doing that, and yeah. So I guess with all the central bank, as long as the central banks do crazy stuff, which they, in my view, have to do, because they've positioned themselves in a corner where they can't get out. They can't raise the interest rates because they will kill the stock market, bond market, real estate market, everything, the economy. Nobody wants to do that. So they're doing stupid stuff like printing money and more while saying they're tapering, which, well, I think is the only thing they can do. But that creates opportunities for arbitrage-minded people and just savvy investors. So that will be a big drive in the market for years to come, I guess.
You've got Ken Griffin and Citadel and all these other players coming and salivating at some of these ARB opportunities that you've still got. Maybe we don't have like the 200% cash and carry trade that Arthur Hayes talks about that brought him into the market, or like the massive premium with Japan and the U.S. spot that got Sam Bankman-Fried involved in the market. But it's still a relatively inefficient market for being around 13 years. So PlanB, you talked briefly about options. When I was in Miami, I went to one of these kind of like panels. It was a market making panel. One of the big firms there that I recognized was QCP. These guys are trading like billions in volume a day. Mm-hmm. One of the things that really caught my eye, or I guess my ear, that they talked about was in the gold market, the options open interest is 8 times the spot market volume. Whereas when you compare that with Bitcoin, it's 2%. So, if you're talking about that getting to the equivalent, it's going to be 50x to 400x or whatever, 500x at least, to get even in the ballpark of where that is for gold. So what do you think about the growth of the options market in Bitcoin, and like how is that going to affect like the market in general? Will that damper the volatility as people are hedging around volatility? Do you think that just grows as more institutional players come in? And just like, what's your general thoughts on options growth in Bitcoin?
Yeah, it's the next market that will be next derivatives market that after the futures market has fully matured, will be explored and grown into a full functioning option market. And it's not very mature at the moment. So, for example, if you look at the prices of daily bit, it's the biggest option market. It's very obvious that the trading of the in the money options is not really happening. So it's all out of the money options of people that think that Bitcoin goes to 100,000 or 200,000 tomorrow, and basically betting. It's like betting. It's a form of leverage without the downside, which is the worst way of playing the option market, because you don't do directional bets with options. You do directional bets with futures, and option markets are for volatility. So you sell the volatility when it's high and you buy it when it's low. That's how you ought to do it. But so I guess that will mature, and that will indeed 10x or even more. There is, of course, a big difference with the gold market and several other markets. That is that the underlying, the collateral, the Bitcoin in this case, is very easy to transfer and to verify that it's actually there. And that's not so with gold. So gold is held at I think it's the London Bullion Bank, and then everybody has to trust that bank that the gold is really there. And you can ask for physical delivery, but when things get rough, like right now with all the inflation and then I don't know if you follow the commodity market a little bit, but what happened over the last 1 or 2 months is really amazing, and it's fraud actually on epic proportions, because there were some large investors that traded with options and futures and lost, like billionaire investors, $1 billion positions. They lost but then the trades were canceled.
Yeah, they
So
just stopped the market, right?
They
Was it
stopped the
was
market.
nickel, right?
Trade, wasn't it?
Yeah, and that's not the first time that happens, right? That's they do it all the time, and that's very bad.
Reminds me of GameStop and Robinhood when they just paused trading on GameStop. I mean, it's crazy.
Same thing.
Supposedly regulated, right? These are regulated, and the crypto exchange is the cowboy.
Quite literally, right? For example, Deribit is an unbanked exchange, so there are no bank. You can only deposit Bitcoin. You cannot deposit euros or dollars or whatever. So it's very easy for an exchange to actually hold the collateral, and for you to check it. And there's a lot of new trends going on there as well to make that more decentralized. So I think we're going to so Bitcoin and to the Meester, Raoul Paul, several other traditional finance guys have pointed out that Bitcoin is the pristine collateral, the best collateral there is, even better than real estate because it's portable, of course. And that will change the entire market from lending to futures markets and cash and carry trades and option markets. So I guess we get once that market matures, and that will take some time, several years, I guess. We'll be at much higher prices, but also at lower volatility, and then we build on top of that again.
So would you say that the development of the options market, where it's much better to sell volatility or buy it, will have an impact on reducing, as it develops, it'll be a forceful reduction of the volatility, just as futures markets are, taking the heat out of these like exponential tops?
Yes, exactly. Because more professional parties will enter that are better at estimating those risks and trading those risks. So right now it's basically lottery ticket buyers and some institutional sellers that are laughing at the 25% profit they make. While it would be much more interesting if the option buyers are more professional and more into have a real use case for buying those options instead of just lottery tickets. And so there's like with the futures market, there's usually a lot of an entire market behind it, like the agriculture or commodities markets that are for the building industry. So people use those instruments like futures and options to hedge their invoices that they know are coming from stuff they bought, raw materials and stuff, and from the bills they will be sending to customers. So they hedge their positions if they use it professionally, right? They're not gambling on the market. They just know that they can't stand the volatility, and they're willing to give a little bit of the profit away to someone who can hedge or stand that volatility or has a position that offsets that volatility. It's sort of a natural hedge. And so yes, in the end, I think that will drive volatility down over the next years.
Would an example of that be like, say, you're using Bitcoin as collateral to fund, get a mortgage, or you're posting that to get a fiat loan, and that you would use it as an insurance policy to avoid liquidation of your loan?
Yeah, but right now that's very difficult because of the volatility. Your collateral will be like up 2x or down 50% in no time, and the lenders will ask for over collateralization, and so that's kind of expensive at the moment. But yes, it will thus make lending based on your Bitcoin on Bitcoin collateral much more attractive if the volatility goes down.
Hey, PlanB, sorry to put you on the spot here, but I just want to clarify something in my mind. Like when we're talking about buying vol, is it a straddle or a strangle that you're buying vol?
if you're buying vol, you buy it low. So when the volatility is low, you can buy a call option and a put option, for example. And then when the volatility goes up, you can sell them again and at a higher price and relatively delta neutral. So you have, so you bought or sold, could also, right? So you buy the put and the call. But what's much less risky is selling the volatility when it spikes up. So you sell the call and you sell the put, which is more risky, by the way. But because you can sell the call with collateral, with Bitcoin as collateral, but there is no hedge for the selling the put. That's unlimited risk if you're wrong. So, but when there's the volatility pattern can be modeled with Garch models, with all kinds of volatility models, and it's very predictable. So volatility is it spikes up, and then it slows down. It sort of it like a fire. It goes down, and you can model that. So when it spikes up, you have to sell the volatility, and then you buy it back later when you know for sure it goes. The spike will not be there forever. So.
Do you think Bitcoin will realize like 60 to 70 volt? I mean, I feel like historically Bitcoin's realized, especially in bull markets, like 70, 80 vol. Do you think, like, how far do you think that'll come down over time?
Well, I think it's now the 1 year options are trading at 60 or 70 implied vol, which is low because they were like 80, 90 and even 100 and over implied volatility. So, but that will go up again. No worries. It will spike to 100 again. And that would be the moment to put your cover call in, for example.
Gotcha. Appreciate the little education here. I got a book out called Option Beginners Options Tutorial, something like that, like some basic options book. I gotta dig into it before the options market keeps getting bigger. I keep putting it off.
I have an advice for you, and I might send you something. Maybe I put it on Twitter as well. It's the Black and Scholes model. It's an option pricing model. I know there's a lot of critique and there's a lot of discussion about normality in the market, et cetera, et cetera. But it's an option model. It won the Nobel Prize, and it has 5 inputs. Make that model in Excel and start playing around with it, and I can send you one. It's quite a big formula, but it's a very intuitive model, and but it's best learned by playing with it and understanding the 5 parameters and the complex interplay between the input parameters in that formula. And it's really nice to understand it because options are everywhere in life, not only in financial markets.
Okay, cool. Yeah, I definitely like that. I'll take you up on that. I want to pivot to macro. So we've got a lot going on in macro over the last 3 months. Honestly, I don't even know where to start. I guess we can start with inflation, 8.5%. The government's saying it's the Putin price hike, even though we've seen increasing inflation for the last year. Obviously, that's triggered this massive sell-off in the fixed income market. And because, obviously stocks are correlated to discount cash flow models, that's drawn down, especially, tech stocks drawn down equities, and Bitcoin has seen this correlation to equity. So kind of want to get your guys' thoughts on overall macro. And then also, like, what do you think about this correlation of Bitcoin to tech stocks? Like, what is it going to take for that correlation to break? I feel like for a while people had been kind of viewing Bitcoin as a commodity. As of lately, it seems like, especially when looking at something like a correlation coefficient, it seems like the market's been viewing Bitcoin as kind of basketing it in with tech stocks. So what do you think about macro? And then what do you think is it going to take to kind of break that correlation with Bitcoin and tech stocks?
I think I'll let PlanB talk about the macro because I'm no expert on that. On the second one, to break the correlation, I mean, I saw this in late 2020, and I even wrote a letter on it that we would break it, and that's because Bitcoin's got its internal adoption curve, right? And I track that relatively closely. It's pinned to my profile, so you can just see the exponential growth in terms of the investment and the new user adoption. And so you're getting this S curve going exponential. Meanwhile, you've got these macro correlation traders that are like whipsawing the price up and down a sideways pattern compared to the S&P and NASDAQ and so forth, right? So you'll see that there's this underlying wall of support, which is from new users coming in to buy it. And eventually that'll meet. And like some of the models I do tries to track what that fundamental valuation is coming in to the market from the new user adoption, or actually any adoption, because those correlation traders aren't actually moving on chain. They're trading futures instruments. You don't see anything moving. But if you're a fundamental buy hold investor, then you'll move it off to your wallet and you'll see it on chain. So you can sort of track that, measure it in like the monetary velocity of Bitcoin. You know, like the metric that you helped with was the supply shock metric. You can start to see all the stuff. And what you see is that as this sort of demand pricing of Bitcoin raises and it starts to meet the actual price, when the two hit, it bounces. And then the last time that got forced to a new range was in October to November 2020, which forced a price run from 10,000 to eventually 50 and 60,000. Now we're in this, again, this ranging motion. Again, we're trading this correlation. And again, the growth of Bitcoin internally is impeding on it. And it's a matter of time before, again, it forces up to the next level. So that's what decouples it. And then it finds its correlation again. So, but I'll hand it over to PlanB for the macro question.
Oh, we could talk like hours on this topic alone. So we both questions, by the way, the correlation thing and the macro thing. I'll be short on macro. Yeah, macro is we are seeing things that we have never seen before. So we are in uncharted territory. For example, Greg Voss is a nice guy to follow, a credit investor, Canadian. He has never seen what we're seeing right now. He's amazed. It's very interesting. Every investor, well, in Europe, the negative interest rates. In the US, the interest rates, the 10 years are going through the roof right now. Inflation, of course, all driving this. But there's a couple of things we have to see. The inflation is not caused by the narratives by what the narratives of the mainstream media are telling us, because they're telling us it's all because of Putin, or it's because of COVID, or no, we had this going on actually. There's some nice stats and charts about it since Biden, for example, got into office, was elected, and even before that, the money printing that we have seen since 2008, basically the acceleration of money printing since the financial crisis, would have led to inflation regardless of what happened after it. So of course they will blame it on Putin or COVID or whatever.
Transitory, it's corporate greed, there's something every month, different flavor every month.
Whatever political narrative you want to attach to it. But in the end, we as investors, and especially Bitcoin investors, of course, know and have to keep the eyes on the prize. It's because of the money printing. And that's where the scary part is as well. So the big question now is, will the central banks and the governments get things under control by raising the interest rate? That's how they normally do it, and stop money printing. Well, of course not. I don't see them doing that, because that will crash everything of value, real estate, the stock market, bond markets, everything. And they will have to reduce spending, which they can't, because they need the money to fund, well, the military or some social program, or keeping banks alive, or keeping other companies alive. So I think they'll see it. It becomes very hard to keep the inflation in tame, but the tame the inflation. So, but what the other scenario is, we get runaway inflation, or maybe even hyperinflation, like we see in emerging markets, right? Venezuela, Zimbabwe, more and more. Turkey now, Argentina. It's unthinkable that we will have that in Europe or in the US even right now. I think there's nobody really of the institutional investors that thinks that's a possibility. But history has shown us that once every 70 or 100 years, there is this big hyperinflation or reset moment that is necessary to keep things going. And Roosevelt did that with the gold, making gold illegal, the Gold Act in 1933. And Nixon did it in 1971, of course, by decoupling the dollar of the gold. So I guess the other scenario is something like that, a new currency, global currency, debt cancellation, a big default. So some big structural big swan event could be on the horizon, and we can't think of what it is, but it will be ugly. So either the central banks or the governments get it under control, which they never had in the last 500 years, or some natural thing, some bad thing, some bit of a disaster will cause a big reset of everything, and then we'll have to start over again. And as an investor, of course, you have very little time to maneuver yourself in a position that you're not wiped out. So yeah, those are the big macro things, I guess. With the correlation, that's a very interesting topic, but that also has this co-integration thing attached to it. So correlation is, of course, that the equities markets go down and the bond markets go down, the Bitcoin goes down at the same time. But what if they don't fall at the same time, but stick together? So they would be co-integrated, and that's the thing we have discussed in the context of stock to flow a lot. But actually, it's a technique, the co-integration, and the pairs trading of currencies that is fully based on co-integration of FX pairs. And correlation is, I think, the next big thing in the derivatives market. So we had futures market that is now kind of mature with the base rate down from 30% to 5%. The next thing is volatility, and of course it will bring the volatility down. But the third thing will be correlation. And in mature markets like the equity markets and credit markets, you can directly trade correlation through the iTrax, for example. And so you can bet on correlation. Will it be positive, negative, or non-existing in the future? And win based on your view on that. And there will be derivatives, strategies like the pairs trading that will make that market. So yeah, what will break it? The correlation? I don't know. That's very, very hard. I do see that Bitcoin right now, the big banks, the institutional investors have difficulty in categorizing what it is. So they look at what desks they have. They have a commodity desk. They have a venture capital desk or a tech stock desk, and they say, well, where do we put this? There's not a Bitcoin desk or a crypto desk. So they put it either in commodity at the commodity desk, which very few do, by the way. So they put it in the tech stock, in the Google, Twitter, Amazon, the FANG venture capital desk, and yeah, I think the guys that work there are just trading Bitcoin like tech stock. And once people figure out that the risk return characteristics of Bitcoin are totally different than Google or Amazon or et cetera, that it will be an asset or a desk on its own. I guess that's one of the things that we could look.
So you just think education in general of Bitcoin as an asset class could, as that increases, the correlation might decrease. Would that be kind of a safe way to summarize that last bit a little bit?
I guess, and I don't know how it will get shape. If yeah, it could be an arbitrage desk. That would be actually a foreign exchange desk. That would be if Bitcoin goes to the foreign exchange desk. That would be if the institutional investors learn that it's not a tech stock, but it can be arbitraged like any other FX. So that would be, in my eyes, a big step forward.
What do you think is the likelihood of some type of credit spiral like we saw in early 2020? I guess obviously like the kind of overarching argument against something like that happening would be that obviously COVID was a black swan versus, we've had basically these rate hikes, transparently talked about for months now. And the market has, whether you want to agree if it's fully priced in or not, has priced some of these hikes in to an extent. You've seen some relatively, defensive positioning in the Bitcoin derivatives market, as well as in traditional market as well. How do you think through the likelihood of some type of event like that happening? And do you think, once that event would, theoretically occur, do you think we get, like the March 2020 playbook on repeat where the Fed steps in with like the QE bazooka, and then, it's like, okay, well, put the Bitcoin trade back on, we saw this playbook in March 2020. Like, how do you think through, I guess, the likelihood of that event, and like what would be from an investor standpoint, the correct positioning and expectations heading into something like that?
Yeah, if I may, that's sort of the fork in the road that we are at the moment. So we don't know. Either there will be this black swan spiky event a la March 2020, and it will be ugly, and central banks have to save it, etc., etc. Or it could also go away, like normally. For example, a scenario could be like, I think the May 9th, that's a Russian Freedom Day. Maybe Putin comes on television and says, well, the war on the Ukraine is over now. We have won it, and we go back to normal. We we put open the gas to Europe again, and all the prices come down, the inflation goes down, and the interest rates with it, and we'll enter a next. So I think it's very, very hard to say, and I certainly don't want to speculate where it will be going. It could be anything.
Yeah, no, that makes a lot of sense. What do you think about we've seen a lot of people like Luke Groman's nailed everything on the head. You've seen that guy Zoltan from Credit Suisse talking about this, about, Bretton Woods 3. What do you think about us being in kind of the early days of the end of the dollar? I mean, obviously this could take much longer than some people expect, but there's been some kind of, I guess, theories around Putin using this war as a means of kind of a beginning of a financial attack on the United States versus like a kinetic war. Do you agree with that kind of theory, either of you, about this kind of being the beginning of the end of the dominance of the US dollar?
Yeah, I think that's true. I think that's a very slow process that has started a couple of years ago, and that involves all the countries in the world, but especially China, Russia, India, the Middle East, oil, and the de-dollarization and the printing of dollars is going on before our very eyes.
Yeah, I kind of think it's going to take a lot longer than people think. We as Bitcoiners keep, I think we're biased to the demise of the dollar, and I don't think it's going to be fast. And if you were to look at, what's happening right now in terms of, very long term, and we're in this really large, strong technical rise. Most of the value that's been created in the last 20 years has been very much tech, internet based. And so if you look at where is that being originated from, majority is dominated in the US. So the US is by far the strongest military force. So the security is high, just like Bitcoin security. You need that. The economy and the core technology is high, and it's very independent. It's energy independent. It's got food independence. It's got technology independence. You look at Russia, and it's like they're going to collapse with these sanctions because they can't get the machines to build their stuff because they don't make it internally. The US is very strong. And then thirdly, in the world currency, it's got that world reserve status and still has very strong from the aforementioned reasons. A lot of us think it's going to hyperinflate. Well, I don't think it is, because it's going to be the last, because it's going to be the weak economies that can't export their inflation to the rest of the countries. They are the first to suffer hyperinflation, as we've seen. And so the weaker currencies and all the current countries that don't have their own, they don't have the reserve status, they can't export the stuff. So it's a very good defensive play for the US, and looking forward into moving into a digital age, they are the leaders. And so I think it's a surprising situation right now where I think it's stronger than most people think, and it's got a lot of momentum behind it. And certainly, the productivity coming out of the US and technology is really, really high. And I don't think you turn that around very easily. And take a look around. It's like, if you're coming from any other country that's lesser developed and you're looking for opportunity, everyone's queuing up to go to the US. And if there's any doubt about, because we're in a creative age of digital talent, if there's any doubt about whether that can be defended, it's like everyone's queuing up there, and all the US would need to do is reduce their, the bars on getting in for the brains trust. And it's bull season for the US and the industries that matter. And it's the opposite for Russia. And people often think the strength of China's economy is huge. And it's China's economy has been building since certainly based on very basic sort of infrastructure gains. And it's like this mass production machine. But that economy is not. I think it's relatively fragile. It's very dependent on other countries as energy inputs, food inputs, and exports, right? And so it's fragile. Like, imagine if China did, say China invaded Taiwan and the world sanctioned it, it would be in deep trouble. That's an interesting thing that the latest war has sort of outlined. If you look at the Chinese economy, it is very dependent. Like the whole economy would, I think it would fall apart if the energy imports were not maintained. So yeah, like the US is the strongest game in town if you're talking at scale, and I don't think that's turning around anytime soon. And the interesting thing with the new Biden, like decision to over its key agencies to figure out a way to effectively get a clarity over Bitcoin and regulate it, is saying we want to be part of this future, and we're not going to ban it. So it's one of the narratives that got taken off the table in the recent couple of months, which is huge. It's huge. So I kind of see the US leading for a long time, even though everyone kind of thinks it's the end of the US dollar and whatnot. But when we're talking about the real stuff that matters, which is industry, technology, and a military to defend that, they're the only game in town. So yeah.
I want to, we haven't even gotten into on-chain. So before we get to about an hour into the conversation, I want to at least kind of get the ball rolling on some on-chain stuff here. I guess we could first start with kind of the overarching view of on-chain. I guess, Willy, we'll start with you. One of the reasons that you had kind of cited ceasing to continue with the newsletter was the kind of decrease in productivity of solely looking at on-chain. So how's that kind of mental structure of the market evolved from looking at solely on-chain to also incorporating other more nuanced factors such as derivatives as that becomes more important in the market as well?
Yeah, it's always interesting because I don't know, it's like the market structure of Bitcoin changes very regularly, almost every year. Like we had a major sea change in like the third and fourth quarter of last year in the structure. Huge futures dominance came in, and yeah, so I've done a lot more work on predictive models using futures meshed with on-chain. It's really interesting now. It's like one of the best model I have now, which is, oh man, it takes a lot of number crunching to get this stuff out. It basically looks at a lot of the on-chain data, many inputs, many signals, and also many signals from futures data, and it kind of self-optimizes and finds out over any time period what is important and what price is responding to, and it gives it weight. And like it's 55% on-chain still, which is really interesting because a lot of people, you know, you're used to people saying it's hocus pocus and it's astrology, but the quantitative model I'm working with, the best that I've come up with so far, is, yeah, it's 55% predictive using on-chain and 45% futures currently. So yeah, that's really interesting. And yeah, like the last, you know, you kind of come into this thinking, I'll write this letter and I should be able to call the top, and I didn't. I was not able to call the top. Why? Because the market changed, and this last bear market going from 70,000 was October, November, down to our lows of the early part of this year. That was not at all on chain. Like nothing on there said bearish. What that was futures selling, which really makes sense. If you're an institution, hell, why would I sell my Bitcoin to cash? You know, I'd only sell it to cash if I can get, like, move that cash into, say, a high gainer, or like maybe equities or something, and I'd redeploy it. But if I just want to just move it to cash because I'm uncertain of everything, well, I'll just hold my Bitcoins and I'll sell the futures and get, they netted 15 to 17% at the top of the market, annualized yield. So that's what institutions will do at the top of the market if they want to go to cash. They'll sell the futures and move effectively, hedge to cash, and get the carry trade of like what was over 15% annualized, which is, you know, crazy kind of yields being in cash. And so what we saw was this immense sell down on futures, calendar futures, and when that bottomed, that called the bottom of that bearish run, and we've been sideways up and downish in a kind of a sideways accumulation upward channel since. So yeah, it's really interesting, the futures data, bringing that in with the models that we're seeing on chain.
PlanB, any thoughts?
Yeah, it looks like we've been doing similar stuff because we've been looking at, you know, I don't do this alone. Like Willy also doesn't do it alone, I guess. So we have a group of quants. They're called the Dutch Quant Collective. It's actually a company. It's also a fund. It's not public. It's not open for public money yet in the US. Certainly not, but that will probably come. But anyway, we're looking at on-chain and futures data. So the big story, of course, was futures data last couple of months, maybe a year. And so the diminishing of the futures spread was, and the movement of the futures spread was very predictive of the price, and especially the difference in how fast that went. For example, in different other coins as well. So there's also futures on other coins than Bitcoin, Ethereum, etc. And they move in different cadence. So the pattern between futures premiums on the different coins and the futures premiums in normal markets is very interesting and very, very useful in predictions, especially if you combine it with on-chain. And so we're suckers for simple stuff. So no big model with 100 inputs and complex stuff. We like to keep it very simple. But it takes a lot of number crunching, like Willy said. the data sets are huge, like half a terabyte, right? The blockchain, and then crunch it. We do all that ourselves. But you can, even something simple like realized price or realized cap. It's so interesting to watch at what's happening there. Not only by looking at, for example, the short-term holders and long-term holder stuff, but also by separating the coins that are in profit and the coins that are in loss, and you get those very different perspectives on the same market that as a person we would recognize as well. If you started a couple of years ago, you're in profit 2 times, 3 times, 10x in profit, and you don't mind if the market falls 20%, 40%, even 60%, you're still in profit. But if you just bought and you're in loss, and you're looking at a 10%, 20% loss, for a lot of people, that's, especially institutional investors, by the way, or traditional investors, that's a big loss. And some of them are forced to close their positions at a loss level like that. So those are 2 very different perspectives, and you can track the dynamics. So you can see how much coins are there in loss, how much coins are there in profit, and what are they doing. You're doing the same stuff, but you can go in a lot of different directions with even something simple as the realized cap. And I like that very, very much. What we still see there in predictability. Although I have to be frank, of course, we didn't see the downturn from 60 to 30. We totally missed that.
Yeah, that was totally futures, eh? That was totally futures.
Yeah.
Not going to make that mistake again. It'll be another mistake, right? Because the market will change again.
Yeah.
Yeah.
So with that being said, like, what do you guys think about kind of current market structure, both from like an on-chain standpoint, but also derivatives? We kind of talked about macro, but just like a lot of these more like Bitcoin centric indicators. I would talk, but people hear me ramble all day. We haven't heard from you guys about your current market thoughts in a while. So curious what you guys think.
It's real interesting in terms of like, there was a lot of bearishness, maybe, we got a little bit of a pump in the last 24 hours, but like, it's been super bearish and people going, oh, it's going 20 or whatnot, and a capitulation is going to mount. But if you were to look at our valuation models like MBT signal, MBTS, every capitulation, like from the 2018 capitulation from 6,000, 3,000, or the COVID capitulation, they really started from medium to high levels of valuation of Bitcoin, according to that metric. And we're actually really undervalued right now. It's near extremes of undervaluation. So I think it's really hard to mount a capitulation because it's oversold to such a degree. So on-chain is like, at that stage of what we call mean reversion, it's so far out from its mean that the gravitational force is towards up, right? Which is where it wants to be. So anyone shorting this in correlation to any crash might have some success, but I think it's limited. It's limited because of that mean revertive force on basically fundamental on-chain valuation metrics. So I feel like that's it. We're just waiting for futures demand to come in, and it's an interesting time. If that doesn't happen, maybe we get a decoupling, because I seldom do I see these kind of long time frame metrics break down. If you look at it zoomed out enough, it's always going to revert. So yeah, I think we're undervalued right now, and it's hard to push it down. It's easier to pull it up on bullish correlation trade, harder to pull it down on the bearish trade.
Yeah, I agree. And at the risk of being called a moon boy, which I'm called anyway. So yeah, all the signals, whether you look fundamental, and I mean, well, like stock to flow, for example, with that, or on chain, realized cap, or other metrics, or in the news, the macro news, the the number of countries that are opening up to Bitcoin, everything is positive. Of course, there can be a black swan. Of course, something can happen that we haven't seen in the past, or that is a real black swan. But volatility is low. Like Willy said, the futures premium is low. I watch that like a hawk. If that will go up again, if the leverage will enter the market again. But even the dormant coins, the people in profit, the people in loss. I can't imagine, unless a black swan, any other scenario that this is one of the best buying opportunities that we have seen in the entire history of Bitcoin. It's compatible to the beginning, 2016, 2011, 2013, or 12 even, the beginning of the bull run. So it's I know that sounds like moon boy stuff, but that's how I look at it.
It's interesting. It's real interesting in that, because when I look at this market, I think the market topped in sort of that May. Capitulation hadn't happened in May going into June. And then we had this relief rally, which is this weird kind of, I've never seen that before, rally to an all-time high, but fundamentals wise, it wasn't reflective. It was almost overbought, and there was no substance behind it, not in the metrics I track. And so I would say we had capitulation. We're being in a bearish sort of sideways accumulation with this sort of weird ass move to 70,000. That's like an anomaly, but the fundamentals didn't support it. It came back down, and we're still in this accumulation phase, similar to that bottom 3,000 in 2019 and the 150 to 250 and 250 in 2015. So we're waiting to come out of this accumulation phase.
It feels like we went through a full cycle in 1 year, right? We had the bull market in May indeed, and then we went through a full bear market from an on-chain perspective. But it doesn't fit, and not in price, of course, because we didn't go down minus 80%. So I get that some people still waiting till Bitcoin drops to 20 or something, but from all other perspectives, we are at the rock bottom.
The price analysis will lead you astray, because a lot of that is very dependent on fractal imprinting of past cycles. And we should have gone to close to that 100K back in last year. The top was taken out of it by the carry trade. So when we pulled back and capitulated down 50%, it wasn't 85%, because we never went into a exponential climb. Yes. We never saw MVRV go to the same heights that we're used to. And likewise, the bottoms was not as exaggerated. And then we had this futures anomaly, and almost, I think, some part of that, I think that last leg up to 70,000 was this, the futures ETFs coming online, and we got like a very sort of futures-based buying. It's just really very
you mean like front running the announcement, or
I just saw buying on futures, whereas on-chain was much more mild. And so you can see where the demand's coming from. It's like people not buying the underlying, they're buying futures instruments. And then if you're buying the futures instrument, maybe that's coming off the ETF, but that ETF is so expensive to hold that those guys are traders. So it got traded up to the 70,000 in an anomaly of a trade before it. Maybe it was correlated to the NASDAQ and the S&P, but it was, I think it's anomalous, but if the data, the fundamental data looks different. And I'd say things are responding very, very quickly and differently. So we had this very strong buying, in alignment with Do Kwon's what is it, like almost 2 billion he's bought now over a number of weeks. So you saw this spot demand come back in from not only spot markets and on-chain, which monitors that effectively, and you saw it come in on the futures, and you see the spreads expand again. And it was like, hallelujah, the bull market's back in, it's expanding. But that whole thing reversed very quickly in 1 week, this last week. And it just went from like big bullish bubbles on my model to one day of neutral and then red, and it flipped on a dime. And I think we'll see more of that as well. This thing's becoming very responsive and less, long-term sort of steady, predictable.
I think like the kind of the overarching view I've been seeing is just that you have pretty strong accumulation on chain. I mean, whether we want to look at that from supply had not moved in at least a year, we look at long-term holders, we look at illiquid supply, we see dormancy flow coming, down at like the fourth or fifth lowest it's ever been, obviously for listeners, indicating that you've got a decrease in spending from some of the older guys. So, I mean, I think like the general kind of view I've been seeing from, removing some of the on-chain jargon that, we're all accustomed to, it's just that like you're seeing a lot of accumulation. And then from the futures market, we've talked about how the kind of 3-month basis has cooled off, which I think as we've noted, has shown like a decrease in speculation. But also as we talked about, the market just getting more efficient. But I do think to an extent it illustrates kind of a nice reset or cooling off from the futures market. The other thing is just we've been in this like really long period of, or what I like to call a regime of spot premium. Whether we look at that just like an aggregated way of just comparing spot to perps weighted by volume and open interest, or if we look at, like Bitfinex spot compared to Bybit perps, or like some of these like exchange to exchange comparisons premium. I think in a general sense, you're seeing that accumulation on chain paired with a nice kind of cooling off from the futures market. So, I mean, I agree with you. I think, I think in a broader sense, like kind of the safest way to kind of phrase it would just be, this is a really good area to average into BTC. I think there's that non-zero, chance of some type of, macro credit spiral where you get a capitulation-esque move in BTC. But in that case, I do think you probably get a large monetary response from the Fed anyway. So I think, you average in pretty heavily, more than you would traditionally in your DCAing, and then but keep, a non-zero cash allocation unless there's some type of capitulation move like that. But I agree with kind of what PlanB said, that I think unless you get some type of either credit spiral or maybe contagion effect, coming off of some of the stuff with Russia, let's say someone was like levered up to Russian exposure, I don't know, something like this that has this kind of contagion effect where, no one really saw it spreading. Maybe that has some type of, impact in terms of creating that type of capitulation move. But I think aside from that, as we've just talked about, like, I think in all of these kind of broader indicators, MVRV, dormancy flow was one of the ones we mentioned, reserve risk, the realized HODL ratio, even something as simple as like the Mayer multiple, which is like, that's like one of the OG valuation metrics. I mean, all these things are just kind of in that lower, 10 to 25% percentile in terms of like relative valuation for BTC. So definitely think it's a, great time to at least average into a position, maybe not, buying today, assuming it's the, macro pico bottom, but, kind of averaging in over the next month or two amidst this kind of uncertainty. And I think is probably a pretty good idea.
Absolutely.
And even with that, like white swan, like we saw in COVID, where there was a liquidity crisis, as everything sold off to cash, Bitcoin was, of course, affected. What we monitor here is the fundamentals, and like in COVID, it was a very mild dip. There was a very little blip. There wasn't a great sell-off, and so I think that would be the same. You would get this wick down. If you're leveraged, you'd get liquidated. But if you're just accumulating spot investor, it's just like you just bide your time, and within 2-3 months it reverts back up to its proper valuation. Yeah,
I guess the only like rebuttal I would say to like expecting, and I'm not like putting words in your mouth, but I would just think for anyone expecting like a 50% down move in BTC if something like that were to occur. I think the difference between now and March of 2020 would just be in some of like the positioning in the futures market. I think, we were heading into a halving. And so when you look at funding rates or, like spot premium, the futures market was pretty jacked up heading into the halving. Everyone, expecting the traditional move that we've seen in BTC. And then you also pair that with like the one other chart that I think is really interesting from like a broader sense is like the percentage of futures collateralized with Bitcoin versus stable coins. And so like the more, the larger the percentage of all the contracts margin with BTC means that there's a higher potential convexity, which is, just a fancy word for listeners to say like, as let's say you're longing BTC with BTC as collateral, the trade starts to go against you. Not only is your P&L, your profit and loss decreasing, but also the collateral you put up for that contract is decreasing as well. So the likelihood of you getting liquidated or stopped out of that trade is much higher being collateralized with BTC if you're long. So, I think we've come down from like 70% of all the futures market collateralized with BTC. Maybe the figure off the top of your head, down to like 30% or 35%. I mean, it's been at least a 50% drawdown in the amount of contracts margin with BTC. So I would just say like the derivative setup in general is just a bit less jacked up and frothy compared to like heading into March 2020. So, I mean, maybe we could get a capitulation move in, maybe 25-30% type of day, but I think the likelihood of like a 50% down move is pretty minimal.
Yeah, I agree. Yeah. And if you look at historic events, there's, I guess, 3 of those events. One in 2018, and that was basically because of the fork of BSV and all the narrative and fear around it. And then we had, of course, the after the Mt. Gox debacle in 2013, we had in 2014 the sell-off because of the hack of Bitfinex, and everybody, oh, there we go again, and we just had Mt. Gox, now we have Bitfinex, the same thing, and then it really capitulated. And then in 2011 we had a big capitulation, but that was, if I'm not mistaken, because of the first hack of Mt. Gox, or some troubles at Mt. Gox, at the time the only exchange in the world. So big structural Bitcoin specific events happening, and I don't think that's on the horizon as we speak.
Yeah, I think that's well said. Before we kind of get towards the end of the conversation, I want to kind of zoom out for listeners. So, I mean, a lot of what we've talked about has been kind of what's going on currently with macro and the Bitcoin market specifically. When we zoom out, what do you guys think are some of the, maybe it's macro or just, breakdown in trust and fiat system? Like, what do you think are some of the main kind of catalysts that will propel Bitcoin forward, or potential events that you think will that have a high probability of playing out that you think will cause that large markup in BTC? I guess what are some of the milestones that you think will accelerate Bitcoin adoption moving forward over the next 3 to 5 years?
Wow, 35 years is a long time.
Yeah.
You go first, PlanB.
Yeah, well, a normal answer is that if you would have asked that question 5 years ago, I wouldn't have thought of everything that happens since. So it's probably something we don't know right now that will propel us to the next levels. But if we just extrapolate from what we know, yeah, a second or third El Salvador would really change the game. If El Salvador is a small country, would not be alone in Latin America, but Mexico, Brasilia, or Argentina would join them. That would make the case so much stronger, and so much more difficult for the IMF to crush. So that's something I really watch. And then just normal demand from normal people that go through the institutions, people putting their pensions in Bitcoin, people buying Bitcoin themselves from an exchange. I see it all around me. There's a lot of people that think this is a good time to buy Bitcoin and they DCA in. Of course, you have to be very careful with that, but I see it around me. A lot more people are asking, hey, how do you set up a wallet? And I think that very small adoption is also very important, and that's what we're seeing as well. So as more people invest in Bitcoin, that's just, and maybe on the institutional level, the arbitrage. I think adoption is one thing, mostly retail, but arbitrage, just getting those juicy cash and carry returns that are not so juicy at the moment, but volatility at the moment, or well, it's something else every time. It's better than being in fixed income at the moment. It's better than minus 1% on your bank accounts or on your treasury accounts. So I think it will come from those three angles, basically.
That's Preston's thesis, is he thinks the fixed income market breaking down is going to be what drives that large markup in BTC.
Yeah, which is a very much larger, it's just very much larger than the equity markets, of course. It's one of the biggest markets in the world. They're in trouble.
Willy, any thoughts on your end?
Yeah, it's, like, of course, yes, okay, things move in stages. Like we had the corporate treasury push that Michael Saylor, was the pioneer of, and there's, like later on that led to the hedge fund push, and now these sort of institutional traders, sophisticated quant traders coming into extracting yield. So these are set phases of it, right? That's great. This is always going to happen as it gets bigger, it's mature enough, next thing comes on. But I'm really just looking at the adoption of a new technology. It's like PlanB says, it's like everybody, our neighbors, our friends, they're interested in investing in this as an asset class. And that goes through a very well understood S-curve. And I invested in Bitcoin within the week that I heard of it, because it was told to me like, oh, okay, this is like a digital version of gold. You could store a scarcity and it'd be like a gold. And I was like, it was around a very simple idea through my mind going, oh, okay, like any technology, it's going to adopt. And my analogy was, well, this is MP3s to the iPod. There's going to be from one emerging, bleeding edge, unuser friendly. Can you remember encoding, like before your time? Well, I think then we used to encode MP3s off our CDs, and it would run like 60 minutes to encode this thing, so it'd be a little file so we could play it on our computers in a compact way. And then it took 12 years to get to the iPod, and this was tail end of 2013. So I figured, well, tail end of, let's give it 12 years. We sort of took 12 years. That's equivalent of late 2025. This would come into like a mainstream thing. And I was like, a mainstream thing would be a mature market like gold, which at the time was $10 trillion, and it was $450,000 per coin. And that was my target. I'm going to kick myself if I don't buy at least one Bitcoin now for, I think it was $600. If this thing turns out to 450,000 by 2025 and I didn't invest, I'll regret it. So I went and bought one Bitcoin, and it's that adoption curve. And it is a tech story at the end of the game. No matter how much we talk about each step and financializing it, and I knew nothing of this. I knew nothing of cash and carry trades and options markets and so forth, futures markets. But as this thing goes through its adoption curve, as more and more people invest into it, and more of the industry build easy to use wallets, Lightning Network now, and the work that Strike's doing, there's all manner of innovations where it's making it easy for the common person to hold this asset as an investment. It just continues, and we are actually on track. We're on track with over 1 billion people by 2025 to hold this asset, and the valuations that are coming out are on track for about 500,000. 2025, I think, was it ARK Invest 2030 by $1 million. So yeah, it's roughly ballpark, and I think it's not a narrative, that's just adoption curve, and it's whatever is the next phase of this, which I guess is your question. I was like, I don't know, but I trust in the curve. I just trust in the curve.
There we go. Trust the curve, ladies and gentlemen. I think that's a good place to wrap it up. It wouldn't be a Moon Boy show without any hopium at the end, right? We gotta give the people their hopium. Guys, seriously though, I think that this was amazing. We gotta maybe do this like once a quarter or something like that. It's always a pleasure talking to both of you. I feel like whenever we come together, it's like sometimes 1 + 1 can equal 3. When you bring brilliant minds together, you get a bigger output than the sum of the parts, and as in their own right. I think it's going to be an interesting time for Bitcoin over the next few years. We've got unprecedented times going on in macro, all the things we kind of discussed today, and I guess with that, any kind of final words that you guys want to leave the audience with before we wrap up? I guess we'll go Willy first, then PlanB.
Trust the curve.
There you go.
Yeah. Look long term, I would say. Like all the noise disappears. I think Michael Saylor said that also. Just we're all worried about the next short term move. Maybe we go to 20. Well, this or that is, like this thing's been going for how many years is it? 12, 13 years. Trust it, and we're in the safer range of it, and it's asymmetrical. It's a very asymmetrical bet. If you're wrong, you lose. If you invest $1 and you're wrong, you'll lose $1. Unlikely. You'll lose it all. If you're right, you'll get $10 or $20. And the probability of that you'll win is more than 50%. It's like flip the coin, heads or tails, heads or tails. If you're right, you get $20. If you're wrong, you pay me $1. Who wouldn't take that bet? That's the bet that's on the table. You've got to be prepared to lose because everything's got risk, but it's asymmetrical, and it still is. It's been asymmetrical for a long time. It's still asymmetrical.
Nothing to add. Thank you very much, guys. This was fun. I learned a lot, and certainly let's do it again in a couple months' time and see what we missed.
See how the story progresses. Thanks, Will, for bringing it together.
Thanks, guys. Take care.